A very busy week has just gone by. We've had the Bank of England, the Fed, as well as the Bank of Japan just last night, all having come out to either reiterate their current monetary policy stances or to adjust them. So I'm going to start off by talking about the Bank of England. That was one of the most interesting moves in the markets yesterday, if only the only clear one that I saw directionally. Markets were expecting there to be a 7-1 vote split, where Christine Forbes, who's been a hawk, would be the only one who'd be voting for the Bank of England to increase interest rates by 0.25 basis points. And everyone was going into this event just thinking this was going to be largely a non-event. I was speaking to some of the guys in stage 2 at the time, and I was discussing that the real tradable opportunity at that time would be a 6-2 vote split. That would be relatively more hawkish, except given the fact that the market was expecting a 7-2 vote split. Now, this is another point just to mention. It's never good to be complacent, as we keep saying in the financial markets. We can expect all we want that there's going to be no change to the vote split, but once again we're all nicely shocked that we got a 5-3 vote split, and as you can see on the cable chart here, how violent the move up was. This being said, this is one of those opportunities where you have to be very, very fast reacting to this. You should be preparing for the data coming into this, meaning that you can react relatively quickly, because, oh, this is cable. It's $. Let me just highlight the. There we go. So this was the move here. So this is where it's very important to be up to date, know what the vote split's going to be, what the market's expecting, just given the fact that you could have reacted almost immediately as soon as you heard the word 5, and the whole move lasted a whole 1 minute. And this is one of those opportunities where taking it at market would have been the best option, as opposed to waiting for a technical level, just given the fact that the market was so incredibly surprised coming into this event. It was that fast money move, and since then the market has just been consolidating. We're now looking at the top of this range, but ultimately we were capped by the 128 most of the day coming into it, but ultimately it's taken us to the back of the top of the range. Now, myself, I was expecting a little bit more upside, but then given the fact that we had this Fed meeting the day before, giving us a bit of dollar strength in the market, as well as the political uncertainty leading up to this event, and in the UK political scene over the past month, largely, that move was largely capped. Now, who was it? Who were the people who voted to hike rates? Well, Christine Forbes. This will be her last vote on the Monetary Policy Committee. So this means that 5-3 split would actually go leading into the next event and be a 5-2 split, which would be less hawkish, so she wouldn't be voting anymore. And apart from that, we had Michael Saunders and Ian McCafferty. Both are relatively hawkish, so once again this feeds into that concept of know your Monetary Policy Committee members. The market would have seen far more upside had somebody dovish gone ahead and voted for a rate hike. Now, this being said, it's important to note that the market was surprised by this, because what we have been seeing is obviously inflation is creeping up, and Brexit negotiations haven't even started. We've been going through political turmoil with regards to the general election, which Ant has spoken about in depth in the past few weeks. But it's also important noting that we've had slowing wage growth, which means that we've got inflation ticking up, largely due to our devalued currency. But the wages are not keeping up in line, which means that ultimately this filters through and pinches the consumer, and then the consumers may stop spending money, and that will then obviously be quite detrimental to our economy as a whole, particularly leading up to a very sensitive time in our markets. Given that the Brexit negotiations are now officially going to start on Monday. So it's going to be interesting to keep an eye on this UK political scene. I don't think Theresa May's out of the hot waters right now. I think she was obviously suffering on the back of their general election vote, but then this recent fire in West London, this really shouldn't have been something which was largely political, but unfortunately it's one of those situations where a political spin can be taken on it, and this is what we are seeing at the moment. And an event like what we saw in West London, a fire breaking out in West London social housing block, due to what seems to be quite a large degree of negligence, where there was no sprinkler systems, the alarm systems. Some are saying they didn't exist whatsoever, some are saying they're incredibly quiet, even though there was £10 million invested on that redevelopment of the property, which also seems to be one of the major causes that the property actually caught fire, just due to the cladding on the outside. Why does this affect the UK politics and the election processes and the strength of the Tory majority? Because this is a social issue. People were already very sour to the Conservatives after the general election defeat, and Labour was already picking up momentum. But this is just one of those very unfortunate situations, but this does sort of lead into the support of more social candidates such as Jeremy Corbyn, and this is reflected in the polls, as you can see, with a smile on my face. So over here you can see that the polls are tightening. Jeremy Corbyn's favourability were incredibly low, but that started to pick up. Labour started to pick up coming into the general elections. Now post-general election we've seen Jeremy Corbyn's favourability increase to that higher than Theresa May, and Labour has also picked up steam and now more of a popular party than the Conservatives. So this is all building up to be a relatively questionable scenario, to see if Theresa May can actually hold on to her power, or if the party is going to continue to support her when the favourability of the Tory party as a whole is going down and down, leading into what is going to be one of the most pivotal couple of years for the British public and the British economy. In the light of this, I think it's a bit premature for the Bank of England to be hiking rates, and therefore I was actually very surprised when we saw the 5-3 vote split. But considering this is Christine Forbes' last vote, she won't be involved in the Monetary Policy Committee, therefore the split would actually go down to 5-2, which then leads us on to who's going to replace her. So going forward, it's going to be interesting to see who comes and replaces her, and what his or her stance is on monetary policy, whether she's hawkish or dovish. And let's then turn back and see what was happening to US equities and the dollar and the yields on the bonds yesterday, given this was the day after I'd like to say a hawkish Fed, but this wasn't the case. This was a neutral Fed in a very dovish environment, given the fact that we had those low and just keep an eye on oil here, guys. Relatively neutral FOMC meeting, but this neutral FOMC meeting was following on from actually really bad inflation readings coming out of the United States. The market was then positioning itself for the possibility of there not being a third rate hike. Janet Yellen coming in and all of the FOMC committee members just reiterating the fact there is going to be 3 hikes coming into 2017, which means obviously this is our second one and we've got one more to go.
Change screen.
Yes. And we have one more to go. So this saw us obviously reverse the move that we saw in, let's take T-notes as an example. So this is on the back of those low inflation readings from the United States, and then a relatively neutral or inline message from the Fed resulted in the prices of bonds decreasing, therefore their yields increasing. So I was being asked how relevant this would be, given that this was fully priced in, the fact that they were going to hike, so on and so forth, and how long should we expect to see dollar strength continue to filter into this market, or what we'd call our traditional tighter monetary policy environments, meaning yields increasing, dollar strengthening, and to a lesser extent nowadays equities falling on the back of the cost of capital increasing. Well, this will all depend on how the market is positioned, and has the market now correctly positioned and priced in what the Fed has ultimately communicated to us. and that is that they're going to hike one more time in 2017. And the way to see whether the Fed has, whether the market has priced in the commentary coming out of the Fed is this this tool which I know Anthony speaks about and uses quite a lot, and this is just looking at the implied probability of rate hikes in the forthcoming meetings. Now, it's every second meeting that the Fed has the dot plot projections, revises its inflation forecasts, has a press conference just to ease any market fears given if they do or don't hike rates. So it's every second meeting which is live. So people were initially talking about the 20th of September being the next rate hike. But given the low inflation reading, you can see that, the next one not being one with inflation forecast revisions or what we would generally consider the live meeting, you can see 97.5% probability rates remain the same, with a 2.5% probability that rates go to 1.25 to 1.5%. But then going into September, which would be a more likely meeting in which they'd raise rates, the likelihood of them increasing rates only goes up to just under 20%, 18%. So the market is nowhere near priced in for a hike the 20th of September. This gives the Fed then one more opportunity to hike rates, and that would then would be on the 13th of December, where they'll be able to speak the market and calm them down. If they do, then go ahead to move forward with the increase in interest rates. And we can see that, yes, the implied probability is higher. It's 41.5% chance that the interest rates will be increased by 25 basis points, but the market's still priced at 50% for rates to remain the same. Only once the 125 to 150 basis points gets above 50% will the market then be considered to have priced in a rate hike. So up until we start to see these numbers start to reflect what the Fed has communicated, I feel that dollar strength may continue to prevail. I think the Fed, to quite a high degree, does have a lot of credibility. They have delivered what they said they were going to deliver so far, and largely in the face of decreasing inflation. If you compare this to how the Fed was behaving in 2016, or at least the first half of 2016, where inflation was respectable, the data was good, coming out of the United States, sentiment was relatively good as well. Donald J. Trump was in power, and they were still being very dovish. So given the fact that they said and communicated they're going to hike 3 times and they're already hiked twice halfway through the year, for me, increases their credibility. So I think the market still has some way to go in pricing in the third rate hike. This will obviously be data dependent, as they always say that it will be, and if inflation continues to tick lower, this will be problematic in them being able to achieve their 3 communicated rate hikes. Now, with inflation ticking lower, Janet Yellen did say she's keeping a close eye on this, which of course means we need to be keeping a close eye on this, but she was saying that this was due to wireless telecoms and increase in pharmaceutical prescription pills. Okay, I'm sure that there is data to reflect that, but if we sort of go on to the US inflation rate for the past 2 years, this is on quite an aggressive trend lower, and I'm sure there is more causing this than just the prescriptions in themselves being a little bit more expensive. Granted, the United States do like their prescriptions, but then it's also important to consider the core inflation whilst looking at inflation in itself. As we know, the core inflation strips out its more volatile products such as food and energy, and we can see that with core inflation stripping out food and energy, that as well has been on a downwards trajectory. So what does this indicate to me? This means that the common wordplay that they're using, that this is transitory, blaming it on lower oil prices, well, that they can't really use that anymore, and they haven't, granted. But with core inflation trickling down, this means that the cost to consumers is going down irrespective of decrease in food prices and oil prices. And this is now, of course, we were tracking very healthily above 2%, now it's tracking comfortably below 2%. So we're going to be interesting to see what happens with this inflation scenario. in the United States, and of course an increase in oil prices will definitely go to help interest rates as a whole increasing. Finally, we had the Bank of Japan last night. This was largely a non-event. They stuck on to their mantra. If anything, they were slightly bullish on the economy as a whole, saying that we're coming into moderate growth. Even though this was largely a non-event, this is the third largest economy in the world, so it's another thing which is soothing market fears. If the Bank of Japan is feeling confident in their growth and the health of their underlying economy, then this will inevitably filter through into global sentiment in with regards to the markets. And turning up and looking at oil. We've all been following the oil market quite a lot, and for the past couple of weeks I've spoken about the predicament faced by OPEC and non-OPEC members, so I won't dwell on it too much. But as you can see, this is now looking to be the largest weekly loss since 2015. And once again, what we saw with the DOE report is that US output production increased by 0.124%. This is extremely relevant given the fact that we're at very low oil prices. Normally we start to see US output production decrease around these levels, as you can see previously, with oil bouncing, as well as OPEC and non-OPEC coming out with their commentary trying to talk up the oil market. Now I really can't see what OPEC can do to talk up these markets. The obvious next next solution that they may be able to present is to not just extend but also to deepen their cuts from 1.8 million barrels to, who knows, maybe 2 million, 2.5 million. But does that resolve the underlying issue? What will that result in? That will result in the prices increasing. The prices increasing means that we'll see US output production increase once again, which will negate any attempts via OPEC to bring oil prices up again. Now, this is the predicament, so I feel like the fair value of oil lies largely between $40 and about $50. But there's another aspect we need to consider here. One of the largest producers in the world, being Saudi Arabia, is they have an IPO for Saudi Aramco. So it's very much in their best interests to keep oil prices as elevated as they can leading into the initial public offering, which is at the moment looking to take place at the beginning of 2018. So I feel like there will be much more verbal communication, and they will try to talk up the markets quite aggressively leading into early 2018, just because higher oil prices would increase the value of Saudi Aramco, meaning that they'll get a higher, more money for their public offering of the company. This is obviously for them to start weaning themselves off being so dependent on the oil market as a whole. So I still feel like there is going to be intervention, but for the medium to longer term, let's say post 2018, I believe we're going to struggle to keep oil anywhere near the prices which would be more beneficial for, let's say, Venezuela, Algeria and other countries who are still largely dependent on oil prices. There's one other chart that I'd like to stress here. People who are trading in 2016 would have been very familiar with the correlation between oil and equity prices. Chart overlay. Not copper, sorry. CLE 480. This is an interesting tool if anybody does want to use it, just to look at correlations between various asset classes. So all I've done is I've gone to the product that I want to, or one of the products I want to compare. So I've gone to CLE and put it in a 480 chart, and then I right click, add study, and then use a chart overlay tool, and then type in EP. And this now overlays the chart of, brilliant. And this then goes to overlay the chart of S&P over the top of oil prices, and this will just go to show you that this relatively high correlation that we saw back in 2016 is starting to break away here. you can see over here the top chart representing oil, the bottom chart representing the S&P. And yes, there is a certain degree of correlation here, but if we keep an eye on the S&P here, it has recently just been tearing higher. It's at all-time highs, while oil prices are making very fast and sudden moves lower. So this correlation is something that you should be keeping an eye on, because traditionally, due to the large oil and gas stock names in the S&P 500, a decline in oil prices, and particularly an aggressive decline in oil prices, would weigh on equities. But at the moment, this has now sort of looked to break apart. So I'd be very cautious when trying to play, let's say, a break of oil lower, and trying to play a correlated asset such as equities. Equities are being still heavily driven by incredibly good sentiment data coming out of the United States, which we're going to be seeing today. And everyone remembers the US Michigan sentiment scenario that we had a while back, where we initially had a bad reading which caused equities to sell off quite aggressively, only then to be revised higher and actually print an all-time high. And then we saw an equity fully reverse itself. So this move in the equity market is very much sentiment driven. There are a few things that could now weigh on this sentiment. We've been seeing Donald Trump is back at it again. And he was having to be warned to not fire Mueller, who is looking to once again look into the scandals which he is facing, particularly to do with him actively looking to sack Comey and looking to get aid for that, and then looking into the Russian allegations. Donald Trump obviously came out and said this is the biggest witch hunt in history. And then members of Congress had to sit him down, basically sit him down and say, look, you cannot fire this guy. This would be a remarkably bad decision on your part. I find it incredible that this guy, who has so much power, who's clearly been very successful in his life, needs to be told that he can't go around firing anyone who looks into anything that he has done dirty. First of all, he shouldn't be doing anything dirty, and second of all, he just can't go around firing people left, right and centre. So given the fact that Mueller will likely look into this and won't face backlash from Donald Trump, at least in terms of him losing his job, means that if stuff and dirt does start to come out on Donald Trump and his involvements with Russia and sort of his actions regarding the FBI director, then this once again could open up a lot of risk for Donald Trump. Maybe not as far as impeachment, but I wouldn't put that off the table just yet. So that's the story which is ever developing, the Donald Trump scenario. I still don't think he's actually been able to achieve anything since the time he's been in office. He just has scandal after scandal, and the markets are still relatively bullish on his equity markets. He's managed to repeal and replace, repeal Obamacare at the very least. So that was one legislative win for him. So let's see. In the coming weeks, I'd be looking to keep an eye out on this tax reform. He has been saying, I think about a week or two ago, where he said he's gonna, something huge is coming in 2 weeks. Just his normal sort of mantra, just tweeting out illogical claims. But I'm sure if within the next, let's say, within this quarter, if we don't start to see him make strides towards these tax reform and infrastructure spending, then this will filter through and reduce, or at least look to taper off some of this Donald Trump inflationary pressures that we've been seeing, and equities may then start to look to unwind themselves. That being said, the VIX is still at incredibly low levels. I think last I checked it was trading around 13. So yes, it's not under that very psychological and very relevant 10, but it's not very far away from there. Let's just have a look at the calendar ahead. So looking at the calendar today, the European session is going to be very quiet. We have final May readings for EU CPI. Again, final readings have a relatively limited effect on the markets. But definitely wouldn't be looking to stay in DAX or Euro dollar positions leading into that, or if you are, look to de-risk yourself, take one off, move your stop to scratch for some of the more advanced guys. Coming into the afternoon session, 1:30 US data, housing starts. This is unlikely to be market moving unless it's an extreme outlier, but the main event for the day will be the University of Michigan Consumer Index, which is expected at 97.1. So if we look at the it's basically expected to stay in line with where it has been, the 1, 2, 3, 4, 5, 6, the 6, let me switch over again, sorry. The 6 months average is still tracking extremely high, looking at the 10-year, we're at all-time highs, obviously approaching the 100 mark. So what would be looking for in this, if we start to see a relatively weak number, putting a range of anything above 100 being extremely bullish, of course this would lead to further dollar strength, and we'll see that pricing in of that third rate hike that the Fed had been communicating would then definitely start to filter through into the market, dollar strength, yields rising. But this is one of the few data sets where I definitely keep an eye on US equities, given that this is largely soft data and equity markets are sentiment driven. As a rule of thumb, I wouldn't be looking at equity markets religiously coming into US data, but this is one of those few data sets where I'd be keeping a close eye on US equities. If we start to see sentiment start to taper away, then this would filter through into the equity market. Of course, the more linear move would be with your bonds and your dollar, but any reading under, let's say 94, we'll start to see equities come under pressure. We're already trading at the bottom of the range as it is. Well, we were until we had that phenomenal bounce again last night. And any number over 100, once again, all-time highs for equities, no doubt about it. And just to quickly show you what I mean, where we were positioned on the day, S&P yesterday went to go test the bottom of its range, and ultimately is now sitting a bit mid-range. A low number, no doubt, will go test the low, if not targeting the mid-February high. Anything above 100, a break of the high is definitely go to look at the 2450. At the very least, would be sort of my medium-term target. And the dollar. Oh, so I'm just gonna. A good number would definitely lead for the dollar coming to test these lows we saw in late May, and anything substantial, a break of that would then bring us, would start to look to bring us down to the early May lows. And on the upside, of course, if we get some dollar weakness, where we're definitely tracking at the bottom of this range, and then any dollar weakness, the obvious sort of target would be at the top of the range. I'd be quite surprised if we can then get above there. But these are just some levels to be keeping an eye on. With regards to bonds, let's quickly have a look at the bond market. If there are any bond traders, I feel that T-notes is actually in quite an interesting position. If we do get good consumer sentiment, we haven't even really reversed the low inflation readings yet. So if we start getting good sentiment data, then at the very least I'd expect us to get down to around here, and then a break of these lows, which just means we have quite a far way to fall. This meaning bond prices falling, yields increasing, just in pricing in the third rate hike. Okay guys, best of luck. Just looking at the calendar once again, relatively quiet morning is what's going to be the safer play, looking for the ranges, looking for the extremities, playing it safe. 3 o'clock really does seem to be an interesting time. If we see a good reading, I'm sure this will spark off, well, a good or bad reading, I'm sure this will spark off actually a very good afternoon, or good end to the day. So be cautious, don't take on too much risk in the morning session, particularly coming up to 10:30 when the market generally starts to quieten down. We've got the North American crossover. But 3 o'clock really is where you should be saving a lot of your energy and time for. Thank you very much, guys. Any questions, do let me know. Max, pop into the office every once in a while. Thanks, bye.